Hola a todos, bienvenidos. Mi nombre es Santiago Rincón Gallardo, soy titular de Relación con Inversionistas e Índices en Viva y quiero darles la bienvenida a este segundo panel de este Viva Forum, que hemos denominado Tendencias Ambientales, Sociales y de Gobierno Corporativo en el Mercado de Valores. Quiero agradecer de manera muy especial a nuestros panelistas de lujo del día de hoy, Eduardo, Elena, Samantha, Jaco, Justin y Karina, por su participación. Como ustedes saben, Viva ha trabajado por profundizar el mercado bursátil en México. Las acciones que hemos realizado aportan a que en el mediano plazo, aumente el número de inversionistas, el número de emisoras listadas y el volumen de operación en México. Entre las principales iniciativas en términos de operación, estamos creando instrumentos innovadores que permiten al público inversionista diversificar de forma eficiente sus recursos. Por ello, en Viva estamos haciendo esfuerzos para apoyar que más empresas mexicanas se apeguen a los estándares ASG y con ello obtengan mejores resultados y atraigan más inversión. Estamos conscientes de que los costos ambientales y sociales tienen un gran impacto en el sistema financiero, que existen nuevos riesgos que debemos identificar y manejar, y estamos actualmente trabajando en aportar sobre esto. Sin más preámbulo, quisiera presentar a nuestro moderador el día de hoy. Él es Eduardo Ateortúa, es director para América Latina de PRI, iniciativa global que promueve la inversión responsable. Por 10 años, Eduardo fue gerente de sustentabilidad en Deloitte, en Colombia. Actualmente participa en los comités de vigilancia del Fondo Inversor y Fondo 2030. Es economista con especialización en geopolítica de la Escuela de Administración, Finanzas e Instituto Tecnológico de Colombia y tiene un máster en Desarrollo Sostenible y Responsabilidad Corporativa en la Escuela EOI de Madrid. With that, I'm going to switch over to English. Quisiera recordarle a todos que pueden oír el panel en español o en inglés simplemente dando clic en la barra de abajo. And with that, I'm going to switch over to English and welcome Eduardo. I'm going to switch it over to you.
Santiago, gracias. Un gusto. I'm going to speak in English, but solo para dar una introducción y las gracias al equipo de Viva, a María, Santiago, a Úrsula, a todas las personas que han coordinado este panel. Muy contentos de estar con ustedes. Me uno al mensaje de Santiago. Viva está haciendo una labor muy importante en México para seguir ayudando a evolucionar el mercado financiero y de capitales en el país, y estamos muy contentos de PRI de tener un aliado como Viva que le apuesta a los temas ESG, y eventos como estos es un excelente ejemplo de cómo avanzar en esa línea. So I'm going back to English, and I just want to say hello to all the speakers. We are really happy also to have a panel that is mainly based on women. Women have a very important and powerful voice on the development on ESG around the world. So it's also very important and very good for the region that we have this important example. So thanks everybody for making the time. I'm really happy to be with you to moderate this panel. And so at the end of this conversation, more people that are going to listen to this panel understand the importance and the value of ESG and sustainable finance in general. So thanks a lot for making the time and be with us today. So I will start with a short presentation about how we are seeing from the PRI perspective the evolution of responsible investment in LATAM, and then we are going to start the conversation with our guest speakers. So let me go and share my screen and just show this presentation. And as I say, I just want to start by mentioning how we are seeing the evolution on responsible investment in the region. And as you can see in this slide, this is a market that is growing really fast on the interest on integrating ESG information in their investment process. We're happy and very proud to say that Spanish-speaking Latam, that is the market that I'm in charge of managing, is experiencing the highest growth of increase of signatories around the world between 2019 and 2020. That's a very important news and very important information, especially because, as many people will know, responsible investment and ESG investing in general is a fairly new topic in the region. So it's really important that we experience this important increase on interest on the topic, because there is a lot of gaps that we have with other markets, with more developed markets. So it's really important that we see the commitment and the interest from signatories or potential ones to align with the responsible investment practices that PRI promotes. I think it's important to mention that we start operations in Spanish-speaking LATAM in 2018. We have operations in LATAM since 2010, mainly focused in Brazil. And since 2 years ago, we decided to prioritize 4 markets. Mexico, that for us right now, besides Brazil, is the most important market in the region. We have 23 organizations that we are supporting, including 3 of the main Afores pension funds in Mexico. So that's very important for us. But then also in Colombia, in Chile, in Peru, we have important operations, and we are seeing an increased interest in our initiative and responsible investment in general in those markets. We have right now 69 organizations that are working with us, and we really believe this number is going to continue grow in coming years as, for example, more pension funds and more private pension funds based in those markets continue to develop responsible investment policies. And that will mean that more investment managers based in the region that work directly or indirectly with these pension funds will continue to develop their responsible investment practices. So what I'm trying to say is that the growth in LATAM is driven by asset owners, pension funds, insurance companies, development banks, sovereign wealth funds. We are seeing those organizations showing their interest on responsible investment, but also we are seeing something that is very important, and is that regulators, supervisors and central banks are also sending messages about the importance of integrating ESG in the investment process. That's happening in Mexico right now. We are waiting for the beginning of 2022, when for the pension funds is going to be mandatory to incorporate ESG information into their investment process. We are quite sure that's going to create more momentum about this topic in Mexico. Also, last week, the financial regulator in Peru issued a new proposal for regulations. So pension funds in Peru also it's going to be mandatory for them to incorporate ESG information into their investment and risk assessment process. And there is similar conversations in countries like Colombia and Chile. So with that, knowing that regulation is also trying to go in this same direction, it's quite possible that this conversation that we are having today is going to continue happening in coming years in Latin America. So just to wrap up, I want to tell you some of the challenge that we are seeing for the growth of responsible investment in the region. And I'm sure this is kind of the things that we can talk with our guests today in this panel. So one important issue that we identify and that we know is a big challenge, and stock exchanges like BIVA can play a very important role on finding solutions to this challenge, is the lack of quality of ESG information that is communicated by the companies that investors in LATAM are investing in. So that's a challenge. That's a global challenge. It's not a LATAM challenge. But we need to continue address that. We need to move forward on finding ways to give better directions to companies, especially to listed companies, on the kind of ESG information that investors are interested of getting from companies. I'm really happy and really it was a very important step, as many people that joined this webinar may know. A couple of weeks ago, the Consejo Consultivo de Finanzas Verdes and a very important group of investors based in Mexico or that have important operations in Mexico decide to issue a joint declaration to promote better ESG information in the market. So that's very important, and that's the kind of steps that we need to have better ESG information in the future in LATAM. Also, I think it's very important to consider that the kind of strategies, the ESG investing strategies that our signatories, that investors in general in LATAM will be able to apply will be kind of different from the things that we are seeing in more developed markets. And what I'm trying to say with that is that, as many people will know in this call, we have a big challenge in LATAM about the lack of options in the investment universe that some of the investors based in LATAM have to manage their money or to allocate their money. And with that, any strategy that is focused on screening is not going to be that easy to implement in markets in LATAM. So we need to move forward with strategies like ESG integration. We need to move forward with strategies around engagement between companies and investors, so companies can perform better on ESG issues. And we also need to think about thematic investment, impact investment, that have a lot of potential in LATAM, especially right now that we are trying to get out of this economic downturn and social challenge that COVID-19 is creating. Impact investing, we are sure, is going to play an important role on helping the LATAM economies move forward in coming years. So for us, our plan is to continue expand our presence in the region. We are really happy with the results that we get in the last 2 years, but there is plenty of things to do. And what we are going to do is continue supporting our signatories to help them incorporate ESG issues into their investment process. We are going to continue educate the market, because we understand that there is a lot of people and a lot of organizations that don't know well right now what responsible investment means and why this is an important topic. So with that, I want to move forward with the panel, because again, I think this is the kind of examples of events that we need to continue having, so we can educate the market about the importance of responsible investment and ESG integration in the financial system. So thanks a lot again for all the speakers that we have, Justine, Samantha, Karina, Elena, and Jaco. And let's start. We want to have an interactive and dynamic panel and hear from your insights, your experience on how ESG is helping to evolve capital markets globally, also in LATAM and in Mexico. And with that, I want to start with the first question to Elena and Jaco. And I want to get from you, like a global perspective on ESG. And with that, my question is this: from your experience, as you are seeing, the rise of ESG in the last years globally, did you think that's happening? That we are seeing a rise of ESG, and especially right now in the context of COVID-19, is this a reality? Are we seeing a rise of interest in ESG? Elena, you can start.
Gracias und buenos días a todo. And that's I'm going to say today in Spanish, but I really thank for the opportunity and to be joining you today and present on the panel on this quite important topic. And I'm joining you from Switzerland, in the heart of Europe, where a lot of momentum and a lot of leadership is happening. So can give you that perspective in a lot of detail, but also give you a more broader reflection in terms of what we at Refinitiv as a global data provider have experienced and seen servicing our global customers around the world. So surely there is a lot of acceleration in terms of actions, and it is not only present in The public sector, as you mentioned, a lot of regulation has been emerging, but we do see quite bold commitments and initiatives also coming in from the investment industry, from the corporate community, from standard-setting bodies and organizations. And I think that that's quite important, because the challenges and the transformation that we're trying to enable, and we have to enable if we are to sustain economic growth, are very fundamental, and they do require a lot of collaboration. But it's important to reflect on what drives all of this change, what drives all of these actions. And 5 years ago, we really experienced a landmark year with the agreement of all nations, all leaders around the world on the 2030 agenda, as outlined by the United Nations Sustainable Development Goals, as well as we reached an agreement of a critical agreement on climate change, as outlined by the Paris Agreement. And this really shaped out the agenda for all of us in the next 15 years. And we've been looking over the last 5 years into ways to actually move to execution, delivering on those objectives. Europe took a leading role in that agenda, and in 2018 launched a very comprehensive and what we've seen so far to be the most ambitious action plan on sustainable finance to enable that transformation of not only capital markets, but in transforming the economy towards being more resilient and being a low carbon economy. There is a lot of work that has happened in Europe in terms of really laying the basic, the foundational grounds for developing this agenda. And when I say the foundation, really what that means is, let's start with the basic. Let's have common definitions, common understanding on what we mean when we say sustainable, what we mean when we say green, because there is no industry standard, there is no harmonized understanding on those issues. And without that common understanding, it's really hard to expect consistency in data availability. And it's then really hard to expect consistency and integration of sustainability-related risks and opportunities into the investment decision. So it's a puzzle, or it's a chain reaction that really starts with agreeing on the basics. What we saw at the beginning of the year as the COVID pandemic unfolds was also, interestingly, some skepticism in the market around ESG and sustainability. As companies struggle to survive, there was a sentiment in the market that this focus and acceleration on sustainability will fade away. And actually what we've seen is completely the opposite. We've seen acceleration in commitments, acceleration in actions, and a higher degree of ambition and urgency to act. I'll give you a couple of examples. Last month, as we were celebrating Climate Week and we saw the virtual UN General Assembly meeting taking place, we saw a very unique announcement made by China. And China, let's recognize, is the biggest financer and builder of coal-fired plants. And they, during the UN General Assembly, announced that by 2060, China will be carbon neutral. Although 2060 may sound like a very remote time frame into the future, actually for such a transformative commitment coming in from China to be executed, action should have started happening yesterday. I think that this alone, this announcement alone, signals how significantly changed the market and the degree of commitment to the sustainability agenda has been in this year, in 2020. We also saw a first last month coming in from the US, which has been lagging behind on the sustainability agenda. When the expert subcommittee of the Federal Financial Regulatory Agency issued the major report on climate risk, recommending the SEC, the Fed, and other financial regulators to act urgently and swiftly in addressing climate change as a systematic financial risk. So we no longer talk about flooding and fires and all the things that impact many of us as individuals and many communities and cities. But actually, it impacts the resilience of the financial markets and the economy as a whole. So I think that what we've seen emerging quite vividly in the last couple of months is this very obvious connection between environmental and social risks and considerations as a prerequisite to deliver on economic growth, stability, and resilience.
And Jack, Elena, thanks for those insights. And I just want to mention that I completely agree. The sign that just that China is saying that they are going to commit to move forward on this, obviously because of the position that China have right now in the global economy. That's a very powerful statement. Nevertheless, that is 2060. Is as you say, is things need to start right now if we want to see that big shift in the next 40 years. And Jaco, I just want to go back to some of the things that Elena say about the risk in March, April of 2020, that all this ESG topic was going to fade away because of this big crisis that we are experiencing right now globally. What you are seeing in the last 6-7 months from the FTSE Russell perspective, is this trend getting more momentum because of COVID? What is happening right now?
Thank you very much for that question. I think from our perspective, actually, what I found most striking, certainly, particularly, I think on the climate agenda, but also the broader sustainable investment agenda, is that how little has changed in terms of the prioritization from particularly large asset owners, large asset managers, and how, if somebody would have told me a year ago, we're going to have, global market volatility and a global pandemic that's going to shut us all down, and we're no longer able to send our kids to school. And I think the gut reaction of many investors would have been, well, climate ESG is going to go out of the window. People are going to be focusing on and that hasn't happened at all, right? Actually, I think what we've seen is investors stay laser focused on these topics. Really, the initiatives kind of continuing that rapid growth that we've seen before, and I think that is a sign of how serious and how fundamental these issues are. In the same way that investors are no longer not stopping to think about kind of investment returns or whether the market is going up or down, they also haven't stopped thinking about climate. And I think that's quite different to, let's say, the 2008 crisis, where in many ways sustainable investing, ESG, was seen as the kind of the first thing that you can kind of save money on and kind of shift your focus. Maybe to take a slightly broader perspective. So at FTSE Russell, what we do is we calculate indices, and we make those indices available to a whole range of investors, asset owners, and asset managers to enable basically passive investing. And that's something that has seen a lot of growth in recent years. We now have $11 trillion in assets benchmarked against our indices. We have another $4 trillion worth of assets that are actually invested following those indices. And that number is growing very rapidly. Sustainable investment has actually been a component of that for a very long time. So we launched our first sustainable investment index almost 20 years ago in 2001. But I think, like for much of the finance industry, it used to be very much a sideshow. We were there in 2006 when PRI was founded, etc. And there has been these long roots that are stretching back on sustainable investment. But actually, this was always something that was niche and in some way the toolbox, the sustainable investing toolbox, kind of ran ahead of the market demand. I think what we've seen in recent years is that really flipping around, and what the market demands today from people like us, index providers or asset managers or data providers like Refinitiv, is really something that the market together cannot deliver today. The expectations are way ahead of the toolbox, and that has really sparked this kind of ESG arms race to very rapidly innovate new data sets, new ways of engaging with companies, new investment products, et cetera, et cetera. Now, if you want to think about the kind of the inflection point, when did that really switch? I think I would actually agree with Elena that it was 2015 and the Paris Climate Agreement in particular, because I think that was the one point where particularly large asset owners discovered this topic in a new and different way. And asset owners, I think, are central to what we've been seeing happening in recent years around sustainable investing. And what happened was really kind of the shift going away from thinking about sustainable investment as a risk management tool and as a thinking about, okay, how does sustainability shape my investment portfolio or the returns on my investment portfolio, to saying, look, we're actually stakeholders in the system. The sustainability, the long-term sustainability of this overall system is under threat. And so we need to become agents of systemic change. Right. And that really started from the very largest asset owners, people that manage, I don't know, 500 billion, 800 billion, $1 trillion, and saying, we need to start seeing systemic change. We need our asset managers to manage our money in different ways. We need new types of data. We need new types of partnerships. So you see things emerging like TCFD, you see things emerging like the Transition Pathway Initiative, TPI, CA 100 plus, et cetera, and suddenly you get this real groundswell from the top of the asset management chain that demands real and lasting change. And I think, what we see certainly in our conversations is that these asset owners are really putting their money where their mouth is. And that is also a big difference from what we used to see, let's say, 10 years ago, right? We work this year, for example, with the Church of England pension fund, a large asset owner in the UK. They took their entire passive equity allocation, 750 million US dollars, and put it into a transition index that basically assesses companies on where they are in terms of the climate transition. And it's what I found very striking about is that they basically said companies that are not aligned with the transition or are not providing us with the data around that, they are out of that index. And actually, as a result of that, the Church of England pension fund ended up divesting from Exxon completely because they said Exxon is not aligned with the transition. So it's really driving real investment choices. The last thing that I wanted to say is that obviously it's not only about climate. I think climate is central to what is happening in this industry, and it's really a key driver for the acceleration of this agenda. But we see this kind of moving more broadly into sustainable investment. So we see, for example, a lot of momentum around the SDGs. We recently launched a SDG Index, where basically, again, a large asset owner is pouring billions of dollars into investment products that really try to assess the performance against the SDGs and really start shifting dollars towards more sustainable outcomes. Now, we're obviously still in an early growth phase, right? If you think about this as an exponential curve, we're still very much kind of in the flat part of that exponential curve. But we have hit that inflection point, and that's starting together with the actions from regulators, with actions from beneficiaries, with actions from companies, really starting to reshape the landscape around investing. And again, to go back to your initial question, which is, how has that changed with COVID? Well, it hasn't, right? And that for me is a really striking outcome here.
Perfect. I just want to summarize some of the things that Elena and Jacob mentioned in this first question. And I think it's important for the people that is listening to this panel to understand that, as they mentioned, 2015 is kind of the inflection point of sustainability in general, and also ESG investing, because as they mentioned, Paris Agreement and the approval of the SDGs, that set an agenda for the next 15 years. So what that means is that because of that, we're going to continue listening about climate change. We're going to continue listening about the sustainable development because it's in the global agenda. So this is something that is now here and is to continue happening. I get a lot of questions from investors in Latam that they ask me, is this a trend? And I say, no, it's not a trend anymore. This is happening. You need to move forward and do something about it because this is not a trend anymore. And in this decade that we are studying, this is going to be more and more and more important. And I always try to use some of the words and some of the things that Samantha's boss is mentioning, and especially as many people connecting to this webinar, I'm sure they are aware about the famous letters that Larry Fink is sending at the beginning of every year, especially the one in 2020 that I think is going to be kind of historic in coming years. And in that sense, I want to go from Elena and Jacob perspective of the global view to a more local view from Samantha. And Jacob mentioned something that I really like. I write here that he says that we are now seeing asset owners putting the money where their mouth is. And that's the question that I want to ask you, because that's happening in Mexico. 5 pension funds are putting their money where their mouth is, and BlackRock is working with them to do that. So Samantha, thanks for being with us, and let us know about this important initiative that you developed with these pension funds.
Absolutely, and thank you, Eduardo, for that question, and very much in agreement of what Jaco and Elena have been saying. And maybe before we dive into the Mexico component and the ESG we launched on Mexico, I'll just give maybe a little bit of data as well that goes really hand in hand with everything that Jaco has said. And you're right, I think it was a big moment when Larry Fink in his 2020 letter really said, look, BlackRock is really going to put sustainability at the core of everything that we do. And really what that means, I would say, is really threefold. First of all, it's very much of a commitment of saying all of our active investments will have ESG parameters in them by the end of 2020. And now we're at about 86%. The second one is we want to make sure that we're creating more ESG solutions for our clients so that people have more and more options to invest in ESG. And in that sense, we committed to having 150 new ETFs for investors in ESG. And we're pretty much close to that number now. And thirdly, and that's another really important point that was touched upon before as well, is how as asset owners and really representing our fiduciary duty towards our clients, we're really carrying out our views in investment stewardship towards the companies that we're investing in, and therefore really requiring from these companies for them to follow TCFD and SASB in terms of how they're reporting, so that we really know that they're working in that sense. So those are very much of like the three big pillars that we committed to. And in that sense, what we have seen in the numbers, and going back to what you've all been mentioning, this is clearly not a trend and it's here to stay, is we've seen the growth in demand, at least for BlackRock ESG solutions, go up by 140% compared to last year. So we've seen $32 billion come into ESG solutions this year, which again is practically 140% more than it was last year. So this really, I think, is a good thermometer of seeing how that trend is going. And now coming back to your initial question of where are we at in Mexico, and I think that, and you touched upon it in your initial presentation, is we've maybe lagged a bit behind our European colleagues, but I think there's clearly a trend in Mexico and LATAM to get there. And what we've really wanted to do for Mexico as BlackRock is, again, bring more ESG solutions to the marketplace. And more importantly, by working with the Mexican ecosystem and 5 of the biggest pension plans in Mexico of launching this ESG ETF on Mexican equities called ESG MEX. And we've seen in the last 2 months, $500 million coming into it, again, hand in hand with all of these institutional investors, being very much driven by 5 of the largest afores in Mexico. And we've really seen that appetite grow. And it's one of the largest growing ETFs that we've seen in ESG globally. So a great example of the interest that there is growing now in Mexico. And we certainly expect to see that continuing to grow.
Perfect, Samantha. And again, I think that's very important news. Every time that we have conversations with signatories or potential ones in the region, what we are mentioning to them is the importance to, again, as Jaco mentioned, put your money where your mouth is. You need to, it's very important to commit to this kind of initiatives, but then you need to do it. It's not about just signing to an initiative. You need to really, put your money on this topic. So I think that's a very good sign. And I can say without a doubt that the news about this ETF is getting a lot of traction in the rest of LATAM. So I think that's very good news. And now I want to close this first round of questions and ask Justine and Karina to talk more about a specific part of the market, that is the green bonds and the sustainable bonds market, that we know that this is a market that is getting a lot of momentum from some years ago, and Justine and the CBI team are doing a lot of things to promote this since many years ago. I just want to say hello to Sean. I hope he's okay. He's feeling better. And Justine, I want to start with you, asking you about the green transition. There is a lot of talk because of COVID that we need to move forward on a green transition, that we cannot go back to the old normal. And I want to ask you, what is the role that green bonds have and sustainable bonds have in helping that transition?
Thanks, Eduardo. Good to see you. And so far, excellent commentary from our panelists. I think especially setting the scene on where we really are today. And it's quite exceptional to see that in a little less than 10 years, how much attention this market is getting. And I speak specifically about the ESG component and sustainability. And of course, our focus has been very much on the debt capital markets and the role that green bonds and now different labeled debt products are playing in helping to shift the capital. Because I think that what our listeners today may not realize is that, different to where we were in 2008, as I believe Jaco had mentioned, is that sustainable finance wasn't on the map in 2008. Trickling along behind the scenes, and now we're looking at a market, at least in the bond space, that's about to hit $1 trillion in less than 10 years. And so what that means is we've got a huge pool of capital that's looking for a home. We also have capital that is sitting in developed economies in negative interest rates and is desperate to find yield. And it's yield with bonus features that's going to deliver on what we have been talking about today, which essentially is impact or solutions to our challenges that we are faced with currently. Then you bring COVID into the place, and the question around how this market is operating in this last year. And I would agree. I think that what the debt market component of this market has proven is that green bonds are considered a safe bet, and investors are continuing to not only buy them with insatiable appetite, but also it remains to be very much a buy and hold market. So the volatility profile of green bonds is quite low. At least that's what our market team has been analyzing over these months. And of course, I think that what has happened is you've got this parallelism effect here, that what the pandemic has taught us is that we are not prepared for shocks. We're definitely on the back foot here. And if we can't get it right with a global pandemic, how the hell are we going to get it right with climate impacts that we know is already in the system and is only going to get worse? And so I think investors, since the last 10 years, have been really getting familiar with what they should be looking at and what they shouldn't be looking at anymore. As we've been discussing how asset owners are becoming more active within engaging, there's a better word to say in this respect, to their asset managers, is that, these investments are what we need and we need to have more of them. Climate change, if the pandemic is such an impact, so is climate change and everything else. So, this is really about resilience. It's about building resilience into our system. It's recognizing that globalization has been a success story has also come with its caveats and its weaknesses. And this is exactly what COVID has proven. And there are a lot of lessons to learn. And so again, I think the momentum this is all about risk, assessing risk, and recognizing that non-financial risk is a real threat to our financial system and our investments and our long-term investment decisions going forward. So I think that with now the announcement, of course, hearing from Elena, rightfully so, the advancements that the European Commission has taken on sustainable finance, and most recently the announcements of Europe's green recovery plans, and how out of that 750 billion, 30% of that is going to be looked to be financed with green bonds. That's not just an effect that's, it has an effect globally to other markets where we regionally operate across Southeast Asia. LATAM, as you know, Eduardo, is one of our biggest areas of operation. And of course, China, is that it is all a discussion about post-COVID green recovery and how do we do it, and looking to Europe on, well, how are they doing it and how can we adapt a version of that into our market? And the debt markets are going to play a very, very huge role. And, through a latest survey that CBI did, our investor survey, it was very clear that the big global investors, even more so the green investors, they want EM debt. They want EM green debt. And so that is the opportunity that, really is before us. And now how do we connect that northern capital into the emerging markets that we know are going to urgently need this? Every economy around the world is suffering and is on the back foot. We know that the hardest hit will be in the emerging markets. And so how can we connect that capital that will help to, as they are saying, quote unquote, build back better, underpinned with resilience and a low carbon economy going forward?
Perfect, Justine, and thanks a lot. And I completely agree with your view about that. I think one of the main, lessons from COVID-19 is that for sure we are not prepared for other shocks, and climate change is coming really fast. And I think more investors, especially with the perspective of middle and long term, they now agree that we need to do something about that. So I think that's good. That's completely true. And the other things that you mentioned, that the investors want to what emerging market debt, and with that, I think is perfect fit to go to Karina, so she can tell us more about the recently decision of the government of Mexico to issue the first sovereign link bond to the compliance to the Sustainable Development Goals, to the SDGs. So I think I need to say first, congratulations to the government of Mexico to move forward with this bond. And Karina, please tell us more about the bond and why this is an important instrument for the government of Mexico and for other emerging markets that can follow this same example.
Thank you so much. Good morning to all, and thank you for the invitation. Yes, the issuance of this SDG bond is not an isolated effort. It's part of an integrated approach taken by the current administration to strengthen the social protection system, aiming to close the social gaps and inequalities reflected across the north and south regions of the country, across income levels and vulnerable groups. The Ministry of Finance, we have taken a strong commitment to this social and sustainable agenda. Since the beginning of the administration 2 years ago, we launched a sustainable finance agenda within the Ministry of Finance to promote these initiatives at the financial sector in Mexico. We wanted to be an example. And one of the first, the first activities we did was to create a sustainable finance department within the public credit unit. And we decided to focus our efforts on the initiatives that will have the greatest impact on the market, such as this SDG bond. And we were also very happy to find a large sustainable finance ecosystems already taking place in Mexico. So in summary, the framework provides the overall basis for linking investors to Mexico's 2030 agenda, promotes transparency in public spending, and provides a pool of eligible expenditures linked to individual SDGs, and sets the standards for impact reports for investors. The bond framework is embedded into the long-term 2030 agenda for sustainable development strategy, and its tools and mechanisms are already established by the government of Mexico around this agenda. We use some of these tools and mechanisms as inputs to build the framework, and they have allowed us to develop the following 3 key unique features in our framework. Since Mexico's commitment to the 2030 agenda in 2015, the government kicked off efforts to develop a SDG budget tagging tools, mapping the federal budget against the SDGs in a granular fashion, a task that was finalized by implementing into the 2019 federal budget. This effort has been done only by a few countries in the world, including some OECD countries. And this is precisely one of the key features that makes our framework unique, as provided us with a rigorous entry point eligibility criteria to select only budgetary programs that had strong linkages to the SDG from our federal budget, and not as an afterthought exercise, more like in a more loose way, no? We are still improving this methodology of this budgetary mapping tool against the SDG, and so our framework and the impact report will continuously be evolving. As we had some additional selection criteria, include some restrictions from our debt law that only allow us to issue debt for productive investment purposes. So we have basically capital investments and human capital, selection. We also remove any negative spillovers effects from the selected budgetary programs and the programs that did not have already established operational rules, or that we expected that it will not continue being funded over time, since we are thinking on a long-term approach. As a result of applying these additional eligibility criteria, the framework targets 11 of the 70 SDG goals set by Mexico, and we're including food security, healthcare, education, water, energy, employment, sustainable infrastructure, sustainable cities, climate action, water biodiversity, terrestrial ecosystems. And for the framework is flexible enough that allow us in each issuance to focus on the SDGs that we want to focus. For this inaugural issuance, we're focusing a lot on the social SDGs. We're not including green SDGs. We're focusing on the SDG 2, 3, 4, 8, and 9, which is basically support for smallholders, farmers, public hospitals and medical equipment, public schools, and basically scholarships, in financial inclusions and rural development. The second key feature from our framework is that we are including geospatial criteria, eligibility criteria for the social budgetary programs, so for the social SDGs, basically, to prioritize only the vulnerable populations living in landlocked and disadvantaged areas. The agenda, the 2030 agenda, is global, but its gaps are spatial and local. So we're trying to actually give the investors the focalizations that will be reflected on the annual impact report. We are using the social gap index that is developed by the National Council for Evaluation of Social Development, that basically has an approach of multi-dimensional poverty. And with that index, we selected around 1,300 municipalities that had the most disadvantaged areas, and to focus the bond on the most vulnerable populations living in these disadvantaged areas. The third key feature is that we have an enhanced multi-stakeholder governance framework led by the President's Office and comprised by 8 national strategic policy and technical committees, including the UNDP, and more than 25 federal and autonomous entities for the implementation and monitoring of the 2030 agenda. So we are actually including the bond agenda into this strong governance already in place of around the 2030 agenda. And I think this is very important because I think for the development issues, it's very important to have multidisciplinary teams in the table. Up until June, I was representing Mexico and the Latin American group at the Green Climate Fund. And the discussions and negotiations were very complex, but also very rich because at the board, the board is comprised by members from the Ministry of Finance, the Ministry of Foreign Affairs, and the Ministry of Environment. And that's very important for development and for these topics because we need to have everybody in the table. So when we were designing the governance mechanism for the bond, I thought about this experience, and luckily Mexico already had the 2030 agenda governance framework in place. So we're just actually including it in the agenda. Since the issuance of the bond, our commitment to the 2030 agenda from the Ministry of Finance side has strengthened, and our participation to these technical and strategic committees has increased significantly because now we have the commitment with the international investors. So we want to issue the impact report, and so we want the fulfillment of the 2030 agenda goals. So I think this is a very key feature, and this is very positive for the rest of the entities since I've heard many times that when the Ministry of Finance gets involved, results are more achievable and more likely to move from just a discussion to tangible results. And since now we're the UNDP, is that this is another key feature. The UNDP supported us by providing an opinion on the framework, and also for further issuances, they are going to act as an observer to the budgetary selection process, and also will provide technical assistance on the development on the impact report to make sure that we are actually selecting the best indicators for monitoring of the SDGs that we're including on our issuances. Finally, I just want to emphasize that all our methodologies and information that we're using are open source, and it can be consulted at the Ministry of Finance website and our dedicated 2030 agenda website. So other countries can look at this experience and have a methodology to actually take as an example. And in the future, we're planning to be a recurrent issuer of these SDG bonds, both in the local and international capital markets, to enable ESG investors to finance Mexico's development agenda. And we're trying to build a new yield curve for these new type of bonds. And I think I'm going to stop there. Thank you.
Thanks, Karina. And I was checking, and I think I just want to mention from your intervention that I think the last thing you mentioned about that this is an open data, and that other countries can move forward and kind of take your experience. Again, I think coming back from what Justine mentioned, if the investors want emerging market debt, for sure this should be something that more governments, especially in Latam, should be looking. So we know that Chile already issued some green bonds with a lot of success. Now we have the case of Mexico. Let's hope that other countries, I'm sure they are working right now on that, and that we get new bonds this year or maybe in the first semester of 2021. I just want to mention that when we planned this webinar, we have a 2 round of questions, but you were speaking a lot, and I don't want to interrupt you because you were mentioning a lot of good things, and we already managed to follow the first 60 minutes of the panel. We have 30 minutes left, and we already have some questions from people that is listening to us. So if it's fine for you, can we go to the questions from the public? Perfect.
Sure.
So I will start with the first question. I have a question for Jaco. The question is this: you say that expectations regarding ESG methodologies are way ahead of the toolbox now available from index and information providers. So the question is, what are you doing to meet those expectations and deliver something really useful to the market?
That's a great question. I think we are very focused on innovating in this area, and innovation, I think, happens on multiple dimensions, right? It's about expanding the coverage. It's about of data or products. It's about the better timeliness of data, better documentation around data that's being used. It's about developing new types of partnerships to work to really solve some of these problems together. I mentioned the transition index that we built with the Church of England. That's actually a much broader collaboration that enabled that data set, that created that underpins that index. So it involves us as a financial institution and as a data partner. It also involves the London School of Economics as an academic and knowledge partner in it, and it is feeding into basically a collaborative initiative from asset owners, which is now backed by over $20 trillion worth of AUM. So we wouldn't have worked that way 5 or 10 years back. And I think it's just an example of how some of these problems are very difficult to solve on their own. Whether it's for a participant in the financial market, an individual investor, or a data provider, or an NGO for that matter. And so what we've seen is a lot of these kind of multi-stakeholder collaborations. I think a lot of people mentioned engagement. So probably the most successful kind of investor engagement initiative perhaps ever is something that is less than 5 years old. It's called Climate Action 100 Plus. They focus on 160 companies that are the biggest systemic polluters in the world, and really bringing together investors from people like BlackRock or GPIF in Japan or Norges in Norway, bringing all of these investors together and formulating demands around credible transition plans for these very carbon intensive businesses. And some of you will have seen at the beginning of the month, there was a big press release around CA100 Plus. And CA100 Plus is creating a new data benchmark. And we're working very closely with them together on bringing that data together. And basically it becomes a league table to see which of these companies are making credible progress and which of these companies are falling behind. Now, that in itself is not new. But to have then over $45 trillion of investor money behind that initiative and engaging directly with the CEOs, engaging directly with the company boards, that is something that is very different. And so maybe to wrap this up, this kind of, I think what is new in the sense in terms of innovation is like, if you don't go to sustainability is very much coming to you. So we just heard about this a great example of the government of Mexico kind of creating an SDG bond, right? And kind of thinking about, okay, how can you make our debt issuance kind of help to finance the transition? We have seen actually more examples of that, but we've seen still many governments issuing bonds with very little kind of focus on sustainability. And what we've actually recently done, we've created a framework to a climate risk framework for sovereign bonds, right? And this is not focused on green bonds necessarily. It's about any bond, right? And why do we create a product like that? Because sovereign bond investors are worried about the climate risk in their portfolio. And they know that climate risk matters actually ultimately for the ability to repay these bonds and default risk and these kind of things. So now if you have your frameworks ready, your policies ready and pushing in the right direction, investors will reward that. But I think what we will see, it will for countries, companies, other issuers, it will become an increasingly uncomfortable conversation if you're not moving on the sustainability agenda.
I think a very good phrase to start summarizing this panel is that sustainability is coming to you. It's coming from you. It's coming to you, yeah. So with that, I just want to mention, you were talking about Climate Action 100 Plus, that this is a global initiative that is looking to connect investors and companies to have more conversations and get information about their climate change strategy. I want to mention that we managed to increase the reach of companies in LATAM that are going to be part of Climate Action 100 Plus. We are in the process of announcing that. We have, until 2018, we only have one company to engage in Mexico. Now we have 3 companies. So that's good news. And that, again, sustainability is coming to you. So if you want it or not, this is happening. And companies also need to be prepared for having more conversations with investors on ESG. And with that, Samantha, I have a question for you. The person is saying that there are now, for the first time, more ETFs than stocks in the US market. And with that, the person is asking what BlackRock is thinking about the possibility of offering products to clients that are, putting more money in ETFs, or if you're looking for other alternatives besides ETFs.
I think that question very much goes around the fact that ETFs are gaining a tremendous amount of momentum just generally. And I think, as we were discussing before, clearly in the ESG space, when I think of the flows that we've seen as BlackRock year to date, of the $32.5 billion that have come into ESG solutions, 26 billion have been into ETFs. So I think that that's into ETFs, ESG ETFs. So I think that very much tells you the trend that ETFs are taking in the ESG space, because clearly we're seeing a great demand for access into ETFs, ESG ETFs, to be able to access ESG investments. They are taking the bigger portion, if you will, of other investment solutions. I think, going back to what Jaco's been telling us, we've seen a tremendous amount of development in terms of indices around ESG. And I think clearly ETFs are the best way to access all of these indices that have been worked on for many, many years.
Perfect. Yeah. And I have this question that I will focus, so Elena, Justine, and Karina can help us with an answer. The question is, who should drive the integration of ESG practice? Should be companies first, or regulators, or investors? Who should be driving these initiatives, or maybe other market participants? And how we can work to standardize this process and not have everybody moving on their own. So Elena, maybe we can start with you.
Sure, I think that's a great question, because it's clear that the shift of capital markets to the 2030 agenda for sustainable development and resilient low-carbon economy simply cannot happen without better standards and transparency. Data was also called out in your intro presentation as one of the key challenges in the region and globally. And everyone has a very critical role to play. Jaco mentioned the need for collaboration. The challenges are not trivial, and they cannot be solved in isolation by any one market participant. And there is a big role for issuers, for companies, currently, and of course investors. All of the ESG data that we currently have available in the market is primarily due to the pressure investors have been putting on issuers to disclose. But that's not enough, and there is the necessity to bring clarity and standardization. That's where the role of regulators is quite essential. There is a critical role that stock exchanges play as well in ensuring that there is motivation and incentive to be transparent and know what information is required to be managed and tracked and reported on. There is a very important role that data providers like Refinitiv play in terms of connecting the dots, in terms of informing different market participants on the state of the play as it is today versus where we need to get, and how do we make the incremental steps to overcome that and deliver the results within the required timeframes. And we've already seen a lot of momentum and a lot of developments in improving and trying to solve for that challenge, with mandatory reporting frameworks being developed in some markets. Inevitably, that will happen across the board. How quickly it will happen, it's another question, and I believe in some parts of the world it will happen sooner, in other layer, but it has to happen urgently across the board. So I think we're really talking about 2 to 3 years at a global scale, in my personal opinion, versus a longer timeframes. From our point of view at Refinitiv as a data provider, we do have very solid commitments at the global scale to contribute, collaborating, and working on solving for these data challenges and bringing standardization, clarity to the market. And from a local context, also worth mentioning that we're working on improving data coverage and availability for Mexico, having more access at scale for Mexican companies, so that local investors can start having a more balance the comparable view versus global investment options when searching for suitable leaders and laggards across the full spectrum of sustainability, as outlined by the Sustainable Development Goals, for example. So I really like the saying that what gets measured gets managed. If businesses, investors know how different environmental issues, social issues impact their future in terms of profitability, in terms of making financial and lending decisions, then they can change and adapt to the fundamental transformation that our economy is in right now. And COVID really has highlighted how important it is that we plan for and manage those systematic financial risks and shocks. Because what we've experienced this year is not an isolated case. We are entering a century of volatility. And now is the time for us to rethink and rebuild resilience into everything.
Perfect, thanks. Justin, from the experience of, seeing the growth of the green bond market, who is the main driver of this? Are companies that issue the bonds? Are the investors that want to buy the bond? Is the regulator that kind of promote this market? Who is the most important one, or is a mix of everybody, helping to promote this market?
I think it depends on how fast you want to move. And I think we need to move faster than we are. And it's clear to the role that regulators play. But keep in mind, the regulators got to get it right in order for it to happen successfully, which is the challenge. It's not always to say because things go in regulation, it goes in the right direction. But what I will say is that this is not the scale that we need, and the urgency of moving the capital to the degree that we need to do, it will not happen under a voluntary approach. And I think that there's going to be a combination of regulatory environment and investor demand. The investor demand cannot be underestimated. And, as we are beginning to see the way the market is becoming more sophisticated, as we've discussed and touched on in today's panel, the investors are increasingly gaining traction and knowledge about what they are expecting to see. I mean, the developments even from, BlackRock's advances, Samantha knows, and, all the way to the top to make those level of commitments, knowing that their own asset owner engagement with BlackRock has resulted in this, and other asset managers, including Amundi and others that are taking effect. This is about survival of the fittest, to be, if we wanted to really look at the major sectors of the global economy and the companies and public institutions that are operating in those sectors, it will be critical that they shift. And so I think that, it will be important that regulators step up, and we have seen that in the central bank space phenomenally, even more so this year than any other year. If we even look at the Brazil Central Bank and the advancements that they have made recently, if we've seen the membership increase across the NGSF, representative of all the central bank community, if we see what's happening with securities and exchange commissions, especially if we focus in LATAM, many of them are stepping up in combination with the haciendas to put in place taxonomies, frameworks, guidelines, as we have seen in the international space, particularly with China and EU. And that's having a trickling effect. And, of course, like I said, regulators are paying attention to this and determining what role they play. And I think that by putting that market infrastructure in place, it does allow for market growth to happen quicker and at scale. And to Elena's point, I think she made it very well at the beginning, is that we do need to have a market entry point. And that is the key word, a market entry point of a common language. What you want to do on top of that is your own prerogative, whether it be regional context, whether it be, to meet specific investors and additional components that may not be required, but there is a common language that we need to be speaking here across the globe so that we can have comparability and consistency in the market to really shift the capital towards the solutions that we need.
Perfect. And following your comments, I want to ask Karina that, as Justin mentioned, we need to move faster. And obviously, this is going to move faster if there is investor demand for all the things that we are mentioning today in this panel. So I want to ask you, from the experience of the issuing of this SDG bond from the government of Mexico, did you see that investor demand? Are you seeing that that's going to motivate that you issue others in the future because you are seeing that investor demand?
Definitely, yeah. We, ever since the roadshow, we had a non-deal roadshow in February, at the end of February. We had a lot of interest on the bond, and we had, when the issuance, we had 6.4 oversubscription. We had roughly 44% of the offering was allocated to 78 new ESG focus accounts. So we expanded our investors base for Mexico. So yeah, definitely it was a good example on how we can improve these investors base and our focus on that, or even in other national funds that we're having, such as the National Infrastructure Fund. This gave us an example also for the development banks. Now we're having conversations with the development banks to actually use the framework as an example, and for them to start having also a program on issuances on this type of issuances. Since they are already doing a lot on it, but that then now what we're looking for is to have it in a more structured manner, no? That we're all, as the government, talking about the same framework.
That's very good. That's very good, and really good to hear that the demand is there. So an invitation to companies and governments in LATAM that they should be looking into this option, especially now that obviously capital is in need. And just to wrap up, and again, thanks a lot for the time. I think a good sign of this kind of panels is that times go flies, and it's like we are wrapping up. So thanks a lot for the time. And I just want to finish with kind of an invitation. We have 7-8 minutes, so maybe a 1 minute answer from everybody. And is that the name of this panel is ESG trends in capital markets. So for people, listening to this event and this webinar, why they need to put more attention to ESG trends that are shaping capital markets in coming years? Why they need to put attention on ESG? Elena, we can start with you.
Sure. Quickly, maybe I'll reference the World Economic Forum annual Global Risk Report, which came out in January for the year 2020, revealing that, and this report, by the way, surveyed on more than 700 global experts, decision makers, and they're asked to rank their biggest concerns over the next 10 years. For the first time in the history of this survey, the top 5 global risks in terms of likelihood to happen, as ranked by the participants, were all environmental. And COVID has shown us how intimately connected the environmental risks are to social and to the economic stability and performance. So if the investment industry is to do its job and what they are paid to do, which is factor in risks, perform due diligence, make the right investment choices, there is no way of doing it without considering the sustainability related risks in the processes. But I think that it's important to end the conversation, at least from my perspective, on a positive note, and encourage the audience that's listening to our conversation today to not think about this whole discussion as a scary topic, as a risk and danger and change and fear and regulation and fines. Actually, what it is a very exciting and necessary transformation that will unfold a sea of opportunities that will enable our society, the financial industry, and the economy as a whole to flourish, to grow back to prosperity, and be able to deliver the performance and the outperformance that we so much need after the COVID pandemic. So really, all the changes and the trends we've discussed today are designed to enable the industry to transform and shift capital towards a better future for all.
Thanks, Elena. I just want to mention, a couple of weeks ago, I was reading an article from Bloomberg Green. They were saying that maybe ESG investing is going to become a bubble. And I was making fun saying, finally, at least we are going to have a bubble that is going to promote sustainable development. So for sure, we need to move forward on this topic. There is an urgency on this. So if we manage to get more capital to work on these topics, it's going to be really, really huge. So, Elena, thanks a lot. Jaco.
Yeah, just picking up on one point that Elena made, I think it's actually a very exciting time to work in this industry, to work on sustainability. I always say that we're kind of in the ways that we measure sustainability, we're maybe where the conventional finance industry was 100 years ago, right? 1920s, 1930s. Everybody is trying to measure financial performance in some way, shape, or form, but it's effectively a Wild West, a free-for-all. There's all kinds of initiatives going on to try to harmonize this data and kind of find a common language, but it's a very kind of messy landscape. Now we know that for on the financial side, for the financial industry, it took about a century to figure this out, to create that common language and those kind of common metrics and common common standards. And what is clear in sustainability and in our efforts to measure sustainability performance, it won't take us a century to do this. Because of the urgency that is behind these issues, we really need to get a grip on sustainable investing. We need to relocate. We need to redirect our capital flows into a more sustainable, into greater sustainability for our economies. So that drives a lot of effort from regulators, from data providers, from asset managers, from asset owners, and frankly also from consumers and citizens to really sort this issue out. And so that's I think what makes this juncture so exciting. And you know, we talked a lot about the different challenges that we're facing, and you know, we could fill hours more with kind of to talk about the obstacles and the roadblocks in terms of bringing sustainability into the investment process. But I think again, going with Elena, I think actually we see for those people that have worked for some time in this space, the amount of change that we've seen in the last 2-3 years exceeds anything that you've kind of seen in the 2030 before that. So that makes it a really exciting journey at the moment. And you know, if there's people out there in the audience that are wondering you know, what to do with their careers or where to go, I think sustainable investment is actually it's a very exciting space at the moment.
Yeah, I have to say that I'm having like every month a couple of mentoring calls with people that is trying to change their careers and focusing on sustainability. So for sure that's happening. Samantha.
Look, I would just, everything's been said. I would just really focus on 3 things. Without a doubt, climate risk is investment risk. And that's very much the basis of where BlackRock's coming from in terms of really being very vocal about everything we're doing. We definitely expect this to be the most important shift of capital. And we, as fiduciary of our clients, really need to make sure that we're providing, as asset managers, the solutions for our clients to really navigate this journey. And thirdly, what I would also stress is the fact that we've definitely seen that companies that follow these ESG parameters are the ones that will do really well throughout time. And really take away the idea of thinking, going back to things that were mentioned before, is this a trend? It's not a trend. And we are seeing the companies succeed, those that are really keeping ESG at the core of everything they do.
Justine.
Yeah, I think it's going to evolve into the transition being a cheaper source of capital than business as usual. That's where we're headed. So for the industrial sectors and companies and everything in between that needs to shift and is not, their access to capital will be limited, their current and future capital. So that's, despite the urgency around what we need to do on climate and other environmental and social issues around our investments, keep that in mind, that's actually the urgent, if there's an urgency that needs to be felt, that's an immediate effect on a company or a bank or et cetera, or even a government for that matter, it's that.
Oh, perfect. Karina.
Yeah, no, definitely. We are seeing that the ESG is allowing companies that incorporate, or governments that incorporate ESG mechanisms have higher returns in the long term. And we are seeing ourselves in the government with roads not being finished for over 10 years because they didn't have an indigenous consultation in place at the beginning. And this gets more expensive for the government on the public infrastructure. Or we have an example of a water plant had to be redone because it was placed originally on a place where the turtles were passing by. So this is definitely something that helps us to mitigate risks and be more efficient on the government expenditures. So it's a matter, it becomes an economic variable.
Perfect. So Elena, Justine, Jaco, Samantha, and Karina, thanks a lot for the time. Happy to have this conversation with you. I hope people learn more about all the possibilities that ESG is bringing right now. And yeah, thanks and have a good rest of the day. Bye.